In his book, The 7 Habits of Highly Effective People, the author Stephen Covey explains habit number 2. For those of you that have read it, and just a reminder, habit 2, begin with the end in mind. And the idea there was to obviously detail the importance of having a clear understanding of your end goal, number 1, and number 2, to also ensure that the steps you take are always in the right direction. So you can also see with this little image on the screen here, that the road to financial freedom is not a straight line. Obviously, it's a bit windy, and you'll deviate sometimes and things like that. But ultimately, the idea is that financial freedom is a goal that many people aspire to, or what I say, strive for, and is achieved by having enough money to support one's desired lifestyle without having to worry about the financial constraints. So that is in a nutshell what we're going to be talking about today. So good afternoon, everybody. My name is Sean van den Berg. I'm investment specialist at PSG Wealth. In today's webinar, I'll be discussing ways to obviously achieve financial freedom. So there's my little agenda for today. My 3 little points as always. So just to give you a bit of a introduction or a bit of an analogy. Imagine you standing on the starting line at the mid-mile. Those of you who don't know, it's an annual swimming event. And you look across this dam, the mid-mile dam, to the other side. You can see the distant finish 1,600 meters away. That's right on the other side of the shore. There's tents and things like that. Now, if you've trained enough for the swim, you should be feeling confident and obviously excited. You may also have the goal of you want to finish the race, and also you might be you're wanting to maybe improve on your personal best times and such. But if you have not trained enough, you'll be feeling a bit uneasy and a bit worried that you may drown. Okay. But every 400 meters in the water are these large yellow, call it buoys in the water. They are markers for the swimmers. So one's at 400 meters, one's at 800 meters, and one's at 1,200 meters. Now, I've used this in the past. Obviously, I've swum the mid-mile a few times. I've used it in the past to try and keep and swim a straight line, or you zigzag, and obviously swim a longer distance. So, but I've also always before the race, I looked on the other side of the shore, and on the hill behind the finishing line there was a tall tree, and I always used to use that as a marker, because once you're in the water, you lose perspective. Okay, you as I say, you lose a bit of direction. So that used to also keep me focused where to swim and things like that. So in the same way, there are also markers or milestones to financial freedom. So that is my little analogy, and I hope it makes sense to you guys. So these, you can call it 5 different markers. And this is, again, I want to use the word perspective. So there's 5 markers or milestones to move in direction and ultimately, obviously, the destination. But before we get there, as I say, I want to gain some, I want to give you some perspective of where many people find themselves. So I'll ask you a question. Do you know what South Africa's national poverty line is? As of 2023, individual living in South Africa with less than 1,058 Rand per month was considered poor. Okay, compare that to the previous year. Obviously, it's 113 Rand higher. Okay, but also you look at any individual that was spending roughly about 760 Rand a month available for food only. They were living below the poverty line. This is all obviously according to the South African national standards. So let me just also take a step back and say, let's talk about South Africa, and let's talk about what the government provides in form of, I call it government handouts. We talk about the SASSA grants. Who qualifies for that grant? It's mainly for the aged, but obviously there's certain criteria. But if you look at that kind of income, it also depends on what grant type. We're talking from 1,100 Rand to 2,200 Rand for someone that's over age of 75. But look at that kind of money. Okay, so the reason I'm saying that is, my point I'm trying to make is that when things are tight and you're struggling to pay bills, you have very little or no financial freedom. Okay, also when you're living hand to mouth with minimal savings, one has very little financial freedom to obviously afford the unexpected expenses or invest in the future. And this is another side. Do you know what the average salary is in South Africa? I Googled this and found quite a few websites that give consensus. The average salary in South Africa is 31,000 Rand. Okay, believe it or not, I was quite surprised, which translates roughly into about $1,667 dollars, according to the exchange rate this month. Annually, this obviously average amount is about 374,000 Rand, or equivalent of $20,000. Okay, so meanwhile, the average weekly earnings of an employee in the US is 1,100 or $4,400 per month. Okay, so compare that to South African figures. Obviously, their monthly income, the USA is around 1,600% to 1,700% higher than in South Africa salaries. Obviously, salaries in South Africa obviously influenced by various factors, and that would include obviously things like your education level, your job type, the work experience, and obviously if you're employed in the private sector or government sector. Okay, but as I said, I just wanted to give you some perspective. Okay, so let's get into step number one. I call it the first milestone. It's beating financial stress and worry. So I say that is because most people, or a lot of people, put it that way, many people are trying to overcome financial hardship, and it's one of the underlying themes in South African lives. Okay, so a lot of people are concerned about financial problems in their life. Okay, so financial stress shows up in many ways, but it's obviously just to do your financial situation. So the most common financial problems, as you see there, is high cost of living or inflation, and it seems like the cost of living is increasing every year, which it is, because it is. Okay, inflation is a natural part of the economy, but obviously it's an understandable financial concern. So the best way to prepare for financial inflation is to make sure you're in a financially solid place. Okay, so too much debt, and I think this is where a lot of people fall into. We're living, I always say, living a champagne lifestyle and a beer income. So having too much debt or not having enough money, etc. And that's a big problem. So obviously, a lot of the young guys will have student loan. I look at my daughter studying medicine. She's got a hefty student loan she's going to pay off one day. You might have past credit spending or unpaid medical bill. It doesn't matter what type of debt you have. The solution, there are solutions. You can. The main idea is to get out of harmful debt. When I say harmful debt, is a credit card. Someone once told me credit cards are something from the devil. Get rid of them. Okay. So the idea is that obviously there's ways and means of consolidating your debt, etc. Okay. Lack of money, low salary income. Obviously there's ways and means there. But it also, and I've spoken about this in past webinars, creating a budget, finding ways where you can cut back on expenses, and slowly get to the stage where you've got some money to work for you. But the main thing is you want to know where your money's going to. That's the idea of creating that budget. Yeah. It doesn't matter what income you have. If you can, you can find a way to cut back on some of those expenses, and you can start saving a little bit. And that idea is to save a little bit and to get into that habit, that savings habit. Unemployment, loss of job. Obviously, there's a lot of curveballs that gets thrown to you. Obviously you can apply for UAF and all this kind of stuff. But obviously you have to reprioritize your expenses, and the best thing to do is to have preventative programs in place, like an emergency fund. Okay, so that's the last point there. Lack of savings or unexpected expenses. I'm amazed at how many people don't have an emergency fund. Something happens to your car and you suddenly need to put 2,000 Rand up, and a lot of people delve into the credit card, and you don't want to be in that situation. So you want to have an emergency fund to cushion that kind of stuff. And we have spoken about this before. So you can see as your milestone number one, in this situation, your goal is to, first of all, create a savings to create an emergency fund. You want to save between 3 and 6 months salary, 3 months, you can say either salary or expenses. Now, if you're earning 30,000 Rand, as I said just now, it's going to take you, if you want to save 3 months, 90,000 Rand. If you're only putting 1,000 Rand away a month to get to that stage, your first goal, it's going to take you 7.5 years. So obviously, if you can focus and put all spare money into it, for example, putting 3,000 Rand, that time horizon comes down to 2.5 years. That's your first goal, I always say, for a young student after paying off your student loan debt, is to get that emergency fund. Number two, well, I have spoken about this before. This is one of the methods I use. I call it the 6 money jars. Most of you have seen this before. I'm using an example of someone earning 20,000 Rand a month. You'd split it up. 10% goes into what I call giving, tithing. I call it first fruits. So that's where, in this situation, you put 2,000 Rand there. And then what's very important is to pay yourself first. That golden goose, that financial freedom account, that's what that FF stands for, financial freedom account. And this is where you're going to build passive income streams, and you never, ever, ever, ever spend this money. Okay, you live off the passive income, but never the capital or the principal. And I'll come back to it in the next slide, how we do that. Obviously, 50% of your money goes into necessities. This is your bond or your rent, utilities, clothes, and things like that. And there's ways and means is obviously start also making that a bit smaller. And then spending money on education. I spent about this before, personal development. This is where you buying the books and the courses to advance yourself. I always use the example of, I think it was Jim Rohn that said, what was the quote? Now I'm just looking for it again. There we go. Formal education will make you a living, and self-education will make you a fortune. So that's the idea of the education side there. It's not for your children's education, it's your personal development. So it's spent, put money aside for that. And then depends also if you, as I say, if you have debt, that LTS will be long-term savings, will be your goal to take 10% and squash your debt as fast as you can. Okay. If you've got no debt, obviously your goal there is to create an emergency fund. And then from there, we can have the nice to haves. And the last one there, 10% fun. This is where you nurture yourself. You work hard for your money. So this is where you're going to take some of that money every month and then, as I say, splurge out to yourself. Okay, so that makes us a bit of an idea of a budget, and gives you, I call it little mini goals, but this is one way to look at it. So this is also something we have spoken about before. You want to get to the stage, let me get my cursor in here, my spotlight. This is what you want. You want to build up from your financial freedom account, you want to build up income generating assets. And we'll be talking more about it today in this presentation. But also, most of us are working for a boss. We've got a job, even if you're self-employed, you still got the income coming in. So it's either salary or bonuses. That's where most people will get the initial income from. And the idea is that you got to put into those 6 little jars. So your income minus your expenses, this will be your IFA. Okay, so obviously there's ways and means of also cutting this back. Doesn't have to be 10%. You might want to bring it up to 20%. But anyway, the idea is that ultimately from your all these different income generating assets, you're going to create passive income. That passive income is going to come back here, and this is going to grow. You want to get to a situation where in the beginning, it might be 90% of your income's coming from your salary, maybe 10% from passive income. You want to reverse those roles around. And that's the idea of financial independence and financial freedom. I hope that makes sense. Okay. So, that's the idea. We'll be talking about these different vehicles in a bit later. Cool. Let me just get back to my cursor. There we go. Okay. Move to the next one. So, obviously, milestone number 2. Going the wrong way. Milestone number 2 is what I call financial stability. This is where you're no more stressing about debt hanging over your head. You can handle it. Either you can handle the debt, you're not worried about the creditors chasing you. If you do have any debt, obviously you have enough income to pay off that money very comfortably. Ideally, as I say, you want to have no credit cards, no loans and things like that. So that's your number 1 goal. There's 2 ways to pay off debt fast. You can use what they call the avalanche method, is we tackle the high interest rate debt first, and you squash that. It takes a bit longer. I prefer what they call the snowball payoff method, is where you tackle the small debts first. Okay, and that's where you take that, once that's paid off, you take that extra money now plus the normal installments, and you compound that into that. So it just accelerates the repayment process faster. What I like about this process is you can see progress. It gives you that sense of progress, we put it that way. Okay. So the goal here with financial stability, obviously you want to get to the stage where you have more choices, you'll have a peace of mind, you'll be feeling more confident. But financial stability is not being rich. It's just it's a mindset. We put it that way. It's a mindset where bottom line is that the idea there is that it's not a number, it's a mindset. It just takes time. It takes time, and you need to put in the work. So your goal here, it's financial stability, is obviously debt elimination, ideally to be free of debt. That's your goal when it comes to financial stability. Let's get to the next one, milestone number 3. This is where we talk about financial security. And the idea here with financial security is that you have enough money to cover all your basic needs. You have a roof above your head, and you're not financial freedom yet, but you have more disposable income for savings now. But also now you can start investing. You have more discretionary spending, put it that way. And that's where we talk about financial security. You have enough money to start investing, bottom line. That's what it is all about. You can start investing, but still, you can see there the second last line there, you're living within your means and building a savings buffer around yourself. So it's not living on a champagne lifestyle on beer income. You're having a beer income, living the champagne lifestyle. I'm sorry, the other way around. I lost my train of thought now. But anyway, you're living within your means. That's what it means. You're not going to debt. So your goal here is now you got already the emergency fund in place. Now you want to aggressively start saving for retirement. I prefer to use financial freedom instead of retirement. In retirement, a lot of people think, I'm going to lie on the beach and do nothing. To me, it's just, I call it rewire, not retire. But the idea is that you're going to have various other goals also. You might have wealth creation goals and a lot of other financial goals. You want to save maybe to a house, to an overseas trip, whatever the case might be. But this is where you have that disposable income now. And then we talk about financial independence. Now, if you had to Google financial freedom, most of the time you'll find that financial freedom and financial independence are used interchangeably. But are they indeed one and the same? So the way to look at it is financial independence. The definition is generating enough passive income to cover your current lifestyle. That's financial independence. And then financial freedom is generating enough passive income to cover your ideal lifestyle. So there's two things I want to highlight there for you. In both situations, we're talking about passive income. Money that you're not working for. It's money. Now, I always say you can work for your money, or your money can work for you. So we're talking about that money working for you, that passive income. Number one, and number two is to say the difference between your current lifestyle and your ideal lifestyle. That's I would say the two different differences there. Okay, but the main thing with financial independence is you've got time freedom. I think that's also very important for a lot of people. You don't have to work for your money. A lot of people still go on. A lot of people will be in their own businesses, not working for a boss. If you do working for a boss, it's something that you really enjoy, but you have that peace of mind, put it that way. So the goal here on financial independence is to create multiple income streams, passive income streams. So in our step number 4, or step number 3, we started all those investments, and those investments hopefully now have got big enough, enough capital in them. Now we're starting to get passive income, be it rental income, be it dividend income, whatever the case might be. That's what we're talking about. But you want to get more and more from all these different investments. And then financial freedom. This is the ultimate goal. Some people will be happy with just stopping at financial independence. Some people want to go a bit further. This is having, as I said just now, having enough passive income to cover your ideal lifestyle. This is the pinnacle of financial success, put it that way. Okay. You might have that lifestyle where you dream of flying first class every time. You might be dreaming of that time where you always have that ocean view on that ocean liner, that holiday in the Mediterranean, whatever the case might be. But you have enough passive income to do the things what you want to, when you want to, without having to worry about where the money's coming from. That to me is financial freedom. So I always say, financial independence is being rich, and then financial freedom is being wealthy. This is giving you a lot more financial freedom, and time freedom, put it that way. Okay, so this is where you can get to a stage where you have abundance, put it that way. You have abundance, you have enough passive income. Now you can start getting to the stage where you can help other people, etc. Okay, so the idea with call it philanthropic, being philanthropic, if that's the right way to pronounce it. It just means being generous with obviously or giving gifts of your time, your talent, as well as your treasure. And so the whole idea is to help other people better themselves. Think of Warren Buffett giving half his wealth away to the Bill and Melinda Gates Foundation. Ultimately, we all should strive to get to that situation. Okay, we're helping a lot of people with our money. I remember years ago, I read a story about Andrew Carnegie. His goal was to give away his fortune. So you might be in the same situation. Obviously we talk about estate planning, we talk about creating a legacy, all that kind of stuff also, but this is your 5 goals. So I hope that makes a bit more sense to you guys. The 5 stepping stones, the 5 milestones. So let's get to how do you grow your investments beyond your income needs. So there's quite a few things, and obviously one size doesn't fit all, but building wealth takes time, effort, and discipline. We all know that. The good news is that there are strategies that can help anyone build and preserve wealth over the long term. And we have spoken about this before in past webinars. The earlier you start, and this is always saying it's important, teach your children about money. We don't learn about the stuff at school. Teach them about money, how to compound, how does compounding work, and all those kind of things. The earlier you start, the better. And also it's understanding how to invest wisely and how to safeguard assets. So, as I say, most let me put it this way. Some investors may be content to generate income from their portfolios without having to grow their overall portfolio, but also most investors would like to see the nest egg, call it nest eggs, increase in value over time. So the best approach, it depends on various factors. As I said just now, it depends on your goals, depends on your the types of investments you choose. It depends on your risk tolerance, depends on your investment time horizon. It depends on the amount of money that you want to invest, and also it depends on your knowledge level. So part of this obviously is, as I say, that's where that education comes in. Learn more about the markets, learn more about investing, etc. Okay. So how do you make your portfolio grow faster? There's ways of means of obviously doing that. Is choosing shares over bonds, for example, investing in small companies, small cap companies. You might allocate some of your money towards that. Obviously, higher risk, higher potential returns. You can also diversify your portfolios, and you can also rebalance your portfolio. Those are some of the ways of doing it. Some of you might have heard of the 80-20 rule when it comes to investment portfolios. The 80-20 rule states that 20% of the portfolio's holdings should constitute 80% of its returns. Okay, vice versa, or not vice versa, and similarly, 20% of the holdings should contribute to 80% of the losses. Okay, so that's one way to look at it. Cool, let's go into more detail. So we talk about traditional investments. Traditional investments, this is what obviously PSG is involved with. Call it traditional, call it conventional. I'll call it the basics. This is where everybody should start. Obviously, unit trust, shares, unit trust, and exchange traded funds. This is what PSG offers, as I said. Shares are part ownership of a company. When you buy a share, you get a tiny slice of that company. Obviously, when the share, the prospects for the companies are good, the share price will go up on demand. And any dividends the company pays out, that's out of earnings. It's another way of you being rewarded as a shareholder. So they are obviously shares are more riskier. They call it bonds, but it's also it depends what share. You don't have to put all your eggs in one share. So the idea is to have a diversified portfolio, and that's one of the most important things for any beginner. Doesn't matter, even a more advanced investor, is the diversification. Spread your risk in different investments. Okay, let's talk about unit trusts. Obviously, they pool the securities. When I say securities, it's a generic term that covers equities, bonds, money market funds, income funds, property, and a combination of all of them. So on PSG's platform, we've got over 450 different funds to choose from. The bottom line, when you also buy a unit trust fund, you're getting a slice of that entire pool. They also vary in risk. So obviously, if you're having exposure just to equities, it's higher risk, obviously higher potential returns than comparing putting your money in the money market account. Okay, so those kind of things also. And then exchange traded funds, ETFs, they trade like unit trust, with each share obviously holding an entire portfolio of securities. Very similar. They trade like shares. So you can trade them through your share trading account. They track major stock indices like the JSE Top 40 or the S&P 500, major industry sectors like obviously the Indy 25 here in South Africa, Financial 15, the Resi Top 10. Obviously, there's different asset classes too. So it's a nice way to also blend exchange traded funds into a normal share portfolio. Okay, but those are the three, as I say, traditional, conventional ways of investing. Then we get to what we call alternative investments. Private equity funds, very similar. Also, they also pool funds together, like unit trusts and hedge funds. Oops, did I skip something? Yep, I skipped the fund. There we go. So let's talk about obviously the most popular one for a lot of people is real estate. And obviously there's been long been a cornerstone of financial success, especially for, they say 90% of millionaires attribute their wealth to real estate holdings. Okay, so so you can either obviously acquire physical property in either be it commercial or residential properties. A lot of people do have a second home, second property, and they're renting out. But you can also have exposure to the property market through shares called REITs, real investment trusts. For example, there'd be like Redefine and Growth Point, and there's quite a few of them. You can also purchase property ETFs. So, for example, One Invest can have global rates. You can also invest into the Satrix property fund. What are you going to highlight for you? You can see you can have exposure for local shares as well as offshore in both scenarios. Okay. Let's talk about hedge funds. So hedge funds obviously also use pooled money and a variety of other tactics to earn returns. Obviously, they can go short. They use derivatives and things like it also. But the main idea is that these guys, their goal is to outperform the market average, what they call alpha. But markets is not the performance is not guaranteed. There are situations where they've actually underperformed by a significant margin. So it's not available for anybody. One of the criteria is at least 1 million rand plus. That's number one. And a lot of two, as I say, you have to be accredited. A lot of times they do a net worth analysis on you and things like that. But the examples you might find is Peregrine Capital. It's the one I always come across, Peregrine Capital. There's another one there, for example, Amplify. But there's quite a few in South Africa. But that's, as I say, that's another vehicle for more of the high net worth individuals to use to make money. The main thing here also, remember, get started for a bit of a longer period. Let's talk about private equity. As I say, it's very similar to your unit trust and hedge funds. They also pool the money together. The main idea here is these guys will invest directly in companies. They either purchase companies, private companies, or they buy a controlling interest in the public traded companies. So usually they buy a big stake, and then they take these companies private. They take the shares off the market. You can think of companies like Consol. They've been taken private. You can think of companies like Edgar's. They were taken private. There's quite a few. But the whole idea is that these private equity funds would take as I say, controlling interest in the operating of the company. They also engage actively in the company itself. They usually also target fast-growing companies and startups. But again, not for everybody. It's a long-term investment most of the time for the investors, 10 years plus. You can think of Ethos, private equity. It's one that I always come across also, Ethos. And there's Metier, another company. And we talk about commodities. Now, this should be a very small part of your portfolio. These are tangible resources, things like gold. Here in South Africa, obviously, we can't get hold of gold bars and gold ingots and things like that, or silver. But also, the easiest way for us to get exposure to physical gold is through Kruger Rands. The last I saw this morning when I looked is that 1 troy ounce of the 1 troy ounce, which is a 24 karat Kruger Rand, costs 47,000 Rand. Okay. So yeah, they also specialize ETFs, which are also designed to focus on commodities. You look at New Gold, very popular way of getting exposure to the gold price. There's also a New Wave Platinum and New Wave Silver. There's also copper and oil. Those are from standard banks. Those are ETNs, exchange traded notes. You can also get involved in rhodium and palladium. That's from One Invest. But if you want exposure to commodities, there's the ETS, exchange traded fund for it. Okay, and then lastly, you have what we call exotic investments. You know, and that's what they call them now. I used to call them collectibles, but the main thing here, these do not conform to traditional perceptions of investments. They actually they don't fall into an asset class mentioned above. So there's various criteria. They're very broad. Think of whiskey, a rare whiskey, call it a whiskey collector. I'm calling about collecting whiskey, or rare wine, fine art, classic cars, etc. So these are just examples, but they're all tangible. Okay, so these assets are usually driven by demand. Remember, there's always two sides of the coin: demand and supply. So this is more demand. So you have to think to yourself, where's the secondary market? If I buy it, who's going to buy it? Who's going to sell it? Who's going to buy it from me? So yeah, but the main thing is they're not affected by market volatility. And it's a nice way to, as I always say, it's collectibles. I call them collectibles. It's a fun hobby, and obviously also gives you that potential for value appreciation. But also, what's nice about it is they can be passed down to your children, to future generations. And also mentioned just now is they provide diversification benefits. Okay, so whoops. So in summary, the main thing I wanted to get across to you guys today was that you know, let me give you some perspective again. You know, if I gave you 1 million today and you die tomorrow, which do you want? 1 million or your life? Yeah, you want your life, and it means that time is more valuable than cash. You know, if I gave you 1 million today, and you know, but you'll be sick for the rest of your life, what do you want? You'd say you want your health. It means that health is more valuable than cash. And if I give you 1 million today, and I say that you know, that your mom is going to die tomorrow, which one do you want? Do you want your mom, or do you want the cash? So relationships are more valuable. The point I'm trying to make is, you know, we are all controlled by something that is not even valuable as everyone makes it. So, you know, money is a tool. That's my point I'm trying to make here. Okay. So guys, we're wrapping this up quickly. You know, financial freedom begins with that end in mind. Yeah. Make it a clear written goal. You might not have financial freedom, but you want to get to a stage, maybe financial independence. Okay, so there's various milestones we spoke about. And the main thing, yeah, to create financial freedom or create independence is to have multiple income streams, passive income streams. So in our context at PSG, we talk about unit trust, exchange traded funds, and talk about shares. Okay, so obviously one way to get income from shares is dividends, etc. Okay, so as we wrap this up, I'm running out of time here. In conclusion, you know, the difference between the poor, middle class, and rich poor people, you know, it's not how much money they make. It's not even how much money they have. The difference between the rich people, middle class, and poor people is what they believe is the purpose of money. As I said just now, money is a tool. So the poor people believe that the purpose of money is to pay off bills, pay off the expenses. The primary purpose of the poor, that's what their mindset is. The only reason they go to work is to get a salary at the end of the month and then hand it over to someone else. The middle class people think that the primary purpose of money is to establish good credit, and obviously so they can go buy things they can't afford and to impress people they don't know, and obviously they have to pay it off over a period of time. Rich people, on the other hand, understand what is the primary purpose of money, and that is to turn money into more money. Money babies. So take the money that you have made, turn it into more money than you had, and then and only then can you be wealthy. You can only be wealthy if you hold on to your money long enough for it to get pregnant and for it to have money babies. Now, if you want to take a 100 Rand note, you put it into the maternity ward. That's what you want to do. You want to put the 100 Rand note in the maternity ward. You want to give it away. You want to put it in the maternity ward and get the money to work for you. So the mindset of the rich is obviously to develop that skill set of investing. I hope that makes a bit of sense. Okay, so a bit of a some more perspective as such. Okay, so there's various ways to do it. If you click on these links here, they'll take you through the key information document. These are vehicles that help you get to that stage. Numerous investment vehicles obviously provide different growth opportunities, various ways to create diversification. Some of them are more tax efficient. It's also something you have to take in consideration. Yeah. So guys, any questions you have, give me drop me an email, wealth@PSG. You can also call me on one stream there, 0860 000 368. Let me see what kind of questions you guys have. As I say, I've run out of time. Doesn't look like any questions. Here's a question from Sandili. Okay. Where do cryptocurrencies fit in? I knew someone will ask that. Sandili, obviously it falls into the what we call alternative investments. Obviously it's high risk. I know that the regulatory environment is changing, but at this point in time, obviously PSG is not involved there. So yeah, to answer your question, alternative investments. There's a question here from Temba. What about Forex trading as a way to make extra income? Yeah, great question, Temba. The Forex market is not regulated. That's the biggest challenge I always find. Something happens, someone, one of these guys is a scam, runs away with your money. What recourse do you have? Where do you go to? So, I have suggested in the past, obviously, CFD trading. We trade the top 100 shares, single stock futures, trade the top 100 shares. You can go so far as to trade currency futures if you already have exposure to currencies. But they're all regulated markets, gives you that peace of mind that something happens, you got that recourse. There's a question here from Yanni. Where does extended family expenses falls into your budget proposal? Yeah, Yanni, that's obviously would be necessities. You might have to take one of those other little jars at 10% long-term savings. That might come in. So yeah, you just have to allocate it. Budget for it and allocate it. I'm sorry about that. Yeah, I understand what you mean by that. That looks like all the questions, guys. Cool. Here's a question from Kristen. Besides dividends, how do you get passive income from ETFs and unit trusts? Do you need to sell to access this money? Yeah, good question. Good question. So some ETFs obviously reinvest the dividends and increases their net asset value. So the capital growth will be there. Some ETFs will pay out dividends. I think they pay it out quarterly, but you have to read the fund fact sheets. It's the same with the unit trusts. So I know that, for example, income unit trust or diversified income unit trust, some of them pay monthly. You'll see the interest coming into your account on a monthly basis. So yeah, to answer your question, Kristen, there's ways and means. Obviously, dividends of equity funds are reinvested. Okay, but interest from income funds will definitely be paid out monthly. Worst case scenario, maybe quarterly. It looks like all the questions. Cool. So guys, from my side, as I said, I've run out of time again. Thank you very much for being on this webinar. Here's my disclaimer. Obviously, I'm not giving any tips as such. It's all for education. But from my side, I can't believe it's the end of April already. My side until the end of May. May, obviously, the last Wednesday falls on that election day. So I'm considering having the webinar on the Tuesday. But guys, from my side, thank you very much for attending. Until next month, thank you, Rajesh. Cool. Until next month, all the best. Bye for now.